Welcome to the July Investor Advisory Review. Hope you're having a great Tuesday and that everything's going well for you. Hope this week's been good and you had a good 4th of July holiday as well. I know we did, and I'm glad we get to get back and connect again. We did this last month, and there's a lot that's changed since last month, and so I've been looking forward to this conversation with you today. As always, we take a few moments just to remind you of the important disclosures that are necessary as you look at managing wealth wisely. We're here to help do everything we can for you. We operate with a mindset that we are client-driven, meaning you come first, but advisor-managed, and we try very hard to make sure we're meeting your needs as we understand them. And these disclosures help to remind you that when it comes to tax discussions, legal matters, banking, lending, investments, etc., please be as involved in that discussion as you can, and we're happy to work with any of your professionals, the people who help you make decisions as well to make the most of your family's wealth and your financial future. We, as always, will take time for questions at the end, but if you have a question before then, you can certainly type that into the chat box, and I'll be happy to take a moment to review that with you, to answer those questions for you. And then for some of you, if your computer setup works that way, we can actually have live question and answers while we're going through these questions with you. There we go. So today we're going to talk about the economic data supporting the market's V-shaped recovery. I'm not sure if you're aware that we've had a pretty nice recovery, but we're going to talk about what that means and what that means going forward. Take a look at the Trump presidency and what we've seen so far in a little less than 200 days now, and how the economy and your portfolio are being impacted by that. We're also going to look at how our management strategies are working and how your investment portfolio is being impacted by these things. Take a look at year-end tax planning, because I know it's only July. It's like, why are we talking about Christmas and Thanksgiving already? But the fact is, as we've shared many, many times before, year-end tax planning is essential because 99% of all tax savings ideas disappear on December 31st. And if we can put some things in place ahead of time for you, that can help reduce your tax bill significantly as you go to meet with the CPA. We're also going to take a look about our difference and how that's impacting what you're doing and what we're doing with you. And then we have a big announcement I'm looking forward to sharing with you. And then finally, that's where we'll take time for your questions, and I'll update you on the next advisory review that we'll be having. So let me start with some of the economic data that is essential to what you and we are doing for you. So look at a few things. Normally I have shown, and I thought about doing it again, but thought, well, let's actually take a look at data this time instead. But the airplane, and showing how the 4 big engines that drive our economy are impacting it. And so I thought I'd show you a few slides here. This particular slide, if you'll note, deals with the consumer sentiment. And the green line you see, that is the S&P 500. So how is consumer sentiment impacting the markets? You can tell that most recently here, and I put a green arrow there on the right side of the slide to show you that we had a very nice jump up in consumer sentiment. Something happened from last month to this month that caused people to be more optimistic about where our economy is headed. It could be that the Trump tariffs have turned out so far not to be nearly as frightening as I think some people were concerned about. It could be because we've seen some different things happen in the markets in general. We've seen the market come back a bit. That's been positive. And maybe there's just some general confidence that things are moving forward in a positive direction. But nonetheless, we can see that with the market moving up, we can also see that the consumer sentiment about the market and the U.S. economy are going up, and they really do go hand in hand. If I were to remind you, look, sort of here in the middle, where you can see the market went down, or the consumer sentiment went down, came back up, and then took down another negative downturn again. And you can see how the market went with that. It doesn't happen every time, but you can tell these are pretty connected. This downturn here and this downturn here, this is back in the when COVID and the pandemic became an issue. So that obviously would have a huge impact on it. And then obviously when we had the 11 rate increases from the Federal Reserve, that also had a big impact. But for now, people are seeing a more positive return to thinking. And so hopefully that will continue on for a while. This particular chart is identifying the need for or the understanding of unemployment and how that's impacting us. And you can see we've had another tick down in unemployment. It's gone down to about 4.1, which is a good thing. Also somewhat connected to the markets and how they're functioning as well. Again, could be that there is a greater need. I know the jobs report just came out last week, was significantly better than anybody expected. And those two items, what you're seeing here on this chart, plus that, have, I think, also led to the market's more confidence, the consumer sentiment, and this sort of recovery that we're experiencing right now. This is a look at GDP, gross domestic product, versus the S&P 500, and you can see that the markets have most recently on the right side of the chart caught up to the GDP growth. We're seeing a real improvement on market performance, and we're seeing a continued growth on the U.S. gross domestic product. So these pieces all come together and add to this confidence that we are probably moving in a very good direction right now. And this one is identifying U.S. manufacturing. And you'll notice here the gold line is sort of the 50 percentile in this calculation. And you can see we are moving up towards that 50 point. Typically, being at 50 or better has created more growth in the markets and the economy. So we're not quite there yet, but it is moving in the right direction. I think all these pieces are coming together with the U.S. manufacturing and PMI as leading towards a more positive belief and confidence in the U.S. economy, and that I think is translating to the markets as a whole. When we see that, we take a look here over the last month, and we can see that the various economic economic indicators for the S&P 500. We're looking at technology, we're looking at real estate, consumer cyclicals, various discretionary spending, technology, and so on. They're all in green, and a few of them are in dark green, meaning that we're in very good territory. When things are more negative, we can see dark red, or we might see just a red, but you can tell that we're either flat or moving up in all 11 industries for the US, which we'll talk more about that. And that was just for the last 30 days. This is a look at what you would call new Dow theory. It used to be a belief that the railroads and industries were the two that you would see. If they were both positive, that would give you an indication the markets were doing better. If they were negative, that would give you an indication the stock market probably wouldn't do as well. Well, we're not a railroad economy anymore. And so what we look at is a number of things, but one of the ones I decided to pull up for today is discretionary spending versus consumer staples. And discretionary spending, when it is on the top here, this is the dark green line, when it's on top, it means that people are feeling better about the economy, the markets, all of it together. When you have the consumer staples, meaning things that people have to buy above the consumer discretionary, it's typically an indication that people are being more conservative, they're being more defensive in their behaviors. And so we can tell here since May that people are starting to spend money again. We can see most recently it has been an uptick in that consumer discretionary spending. Although pleased to promote that the consumer staples have done well also, that we're seeing an uptick there. So these are pieces of sort of that new modern Dow theory that would say, I think we see some really good opportunity here as we look forward over the next 30, 90, even 180 days. This is looking at what we call the inverse yield curve for the U.S. Treasuries. This is looking at the interest rates for the 30-year, the 10-year, the 2-year, and then the United States federal funds rate as well. And we can see those are all up here in a nice area. We find the Fed funds rate down here, the 1.23. But most importantly, right here, this yield curve, when it is below the black line, that's usually a sign that there could be some problems. And when it's above the black line, it's usually an indication that the yield curve is in our favor and makes us be able to take a look at some of the more dynamic aspects of the market and take a look at what are the opportunities that exist out there for us as we invest. That brings me to the chart you've seen before and just a few items to look at on this chart. And this is going back for the last 30 days as well. And we can see that areas like, staples, discretionary, financials are down below in this performance area, which means that people are moving less defensive and moving more aggressive, more risk taker in their thinking about investing. And this next chart shows that area where we can see that we've got discretionary, technology, communication services, and financials all in the green on what we just saw in the previous chart. And some of the areas like real estate, utilities, healthcare, consumer staples, energy and materials, which are typically seen as more defensives, they are in the lesser performing areas right now, meaning that people are moving more towards risk-on assets, which is very helpful. I'd put industrials right there sort of in the middle, so they might even be more to the positive as well at this point. But what that really means is that the economy is recovering. We never really saw a recession. And quite honestly, we haven't had a recession defined since the pandemic. I think there was a big concern we might see that with some of the changes that happened here with the tariffs, but doesn't appear to be happening right now and appears to be pretty strong. Having said that, we're going to talk about volatility here in a moment. So what I would say, this is a good sign again that the markets are working with us, with you, and portfolio opportunity still is great at this point in time. Now, to take all of this and kind of tie it together to where we are, I've shown you this slide, I think, every month since probably March, but it's just a reminder that during his first presidency, President Trump was a disruptor, and he did a lot of things that caused concern for people, but at the same time, the results ultimately ended up being very good. As a matter of fact, as I've shared with you from the beginning of his presidency until 6 months after, he had actually, or we had actually seen an 87% return on the S&P 500, meaning that your money almost doubled in that 4.5 year period of time. But during that time, with all of that great opportunity, we saw two corrections, 10% downs in the market, lasting for 6 months. We saw two bear markets that each lasted 6 months or a little bit longer. And with all of that, those downturns, that volatility, that discomfort, it still did well. I think in the end, the real question we're looking at here is, will the policies that were put forth the first time around and then new policies putting in force now, will those work in our favor with the markets? And as I've shared with you, I think they will, but we are watching carefully because that does create a great deal of volatility. To that point, we can see here that looking at just so far this year, going back to the beginning of his presidency, November 4th, and bringing it forward, we see we hit a high in February 19th. That date was the highest the market had been, an all-time high. And then we had a downturn and more downturn. That downturn was almost a bear market. It was clearly a correction, but it was almost a bear market. But if we carry that forward to today, we can see that the market is up 26% from that bottom back here. And that increase of 26% has been remarkable. We've seen the market come back. It's now hit another all-time high. And so with that in mind, we're thinking, well, things look pretty good right now. But will that be the case? And that's why I wanted to spend a few moments on to take a look at what we think is happening right now and to show you some reasons I'm very confident that we are looking at some more opportunity, but also to remind you that we could be looking at volatility. And while that won't be the end of the world, it will be something we're aware of, especially as we're helping clients manage money. I would point out one other thing on this chart, and it's this little red box up here. There are no guarantees with any president, but with President Trump, and even though the first presidency turned out well when all was said and done, there is going to be volatility. Disruptor or not, the reality is that as you come in and you start trying to change policies and you want to make things better, that means you have to do away with some older ideas that maybe people were entrenched with, they liked, they wanted. But as you make those changes, hopefully in the end, what you end up with is that better outcome that we're looking for. And so what we need to do, what you need to do is make, and I'm going to put right up here, make decisions based upon your personal and family wealth, values, needs, and goals. And by doing that and having a long-term approach to your thinking, that will help greatly as we go through these ups and downs and the volatility that may come with this. So as we look at the markets, and I'm actually going to take you to a live shot of this screen rather than the one I prepared for it. So let me go ahead and get out of there. Okay, so this is year to date. And again, as I was pointing out before, here's February 19th when the market hit an all-time high. Here is the low point of the market where we see the market had crashed. It was a huge day up, and then it was sort of this volatility kicked in. It then began to match, to run up into the 20-day moving average. That's what this green line is. And that 20-day moving average has become a demarcation from this point here till now, which is April 22nd. And so what we can see is we can see the market has run up, it came back down as the 20-day moving average broke through the 50-day moving average. And then we can see as it broke through the 200-day moving average, it tested again. You'll notice how it drops and takes back off again, drops, it takes back off again. You'll note here that it came back, tested the 20-day moving average, and then it came up here. And now we've just recently had just a brief downturn with the market. I've said to you each month since we started having the conversation about the markets and the economy that I was expecting some sort of a V-shaped recovery, but at the same time, I recognized it could be more than that. It could have been something of a great reset because there was a lot of fear-mongering out there in some of the different media sites that you would draw information from. And I also mentioned to you that a lot of the technical traders that we follow were very concerned because they had a lot of information that made them think this could be much worse. The whole tariff discussion really caused a lot of panic and concern for people. But in the end, I thought we would have somewhat of a V-shaped recovery. Now, I will also say I did not expect it to be this fast. I really honestly thought that we'd be looking at anywhere from 90 to 180 days, maybe even 9 months before we'd see this V-shaped recovery come back out. But it has happened much faster. Now, the reason I pointed out the 20-day moving average is because I do believe this is sort of indicative of what we're looking for here as we go forward. And to that point, I would say to you that one, I'm expecting this to come back and test this again. I thought some other things were going to happen that didn't happen, so I'm not guaranteeing you that's what's going to happen, but it just looks like when I look up here, this is what's called the relative strength indicator, and it was overbought, meaning the S&P 500 at this point, overbought and still up running near the top here, which means that there may be some people wanting to take profit off of the table. They might want to take some gains and do some things, which means it'll pull back. But I do think that when I look at past performance, if this were to fall from this high, which was an all-time high, down to say this point here, we're looking at maybe a 3 or 4% fall in the market. It might even go as much as 5, but I don't think this is going to be a long-term trend. Now, why am I telling you this? Because I think that when we come back here to several other points in the month where we started adding money back into the markets, we had clients who had added new cash to their accounts, and we wanted to be careful not to buy in. I mean, hindsight being 2020, been perfect if we just bought everything in back here because we'd be very happy and smell like roses. But we didn't do that because we weren't sure what was going to happen. And so as it's come through each of these trends, breaking by the 20-day moving average, the 20-day average breaking through the 50-day moving average, then the 200-day moving average, as it's continued to test, we've added pieces of money back into it, 20%, 25%, 30% on multiple occasions in the last 2 months. We've got a little bit that we've kept out, approximately 20 to 25%. And based on what we're going to see here, if we get another pullback or if it flattens out and then takes back off again, we're probably going to go ahead and put the rest of it in at that point in time, unless the news says something different. When you start to see the press talk about many things, that starts to get priced into the markets themselves. And so we're watching through that to say we don't want to miss the opportunity, but at the same time, if we can buy it when it has a small dip, that's a great opportunity. We're not day traders. We do look for trends, and certainly the trend right now seems very positive, but we're being cautious still to a point because it can change in a heartbeat. Right now, we don't have anything out there that's too frightening, but I would say is just an interesting point of review. You might remember that just a week or more ago, the United States launched an attack on Iran's nuclear facilities. And I and most of the data I was reading was certain that you would see a pullback in the market, or at least the price of oil change significantly. None of that happened. Or if it did, it was very minor what happened. And so items like that cause you to think that, so when the market is not reacting to bad news, it's because it sees great opportunity and is going forward, and we're trying to take advantage of that for you, with you, to accomplish your goals. And so I would say to you 2 things out of this. One, I love this chart. This is a fantastic chart. We're invested, and we're going to stay invested as long as this is working this way. Second point, I would say, is that when you look at the volatility of President Trump in his first administration, you recognize we could see some more volatility here. And those will be opportunities where we'll be looking to either protect a portfolio or to take advantage of opportunities. And everything changes along the way. There's not a one-size-fits-all model. That's why we try very hard to invest according to your risk tolerance, and then make sure that if we do see something that looks like it's going to be counter to what your goals are, then to make adjustments in those ways for either tax advantages, liquidity needs, income goals, risk tolerance, growth opportunities. We're looking for those items to help you. So with that in mind, I'm going to tell you I expect more volatility, but I also would say I love this chart. And as long as this continues on this way, we're going to be taking advantage of it for you and with you. Let me go ahead and go back here now to where we were before. So as you can tell, with the relative strength indicator in a positive territory, with the markets themselves in a positive territory, with breaking new highs for the S&P 500, and I could pull up the charts for the NASDAQ 100. I could pull up the S&P 500 equal weighted and show you great opportunities. The Dow itself. All of these are very much connected right now, and we see a very connected market and economic model at this point. But again, volatility can run the show once in a while. And certainly if something bad were to happen, we'll be having more conversations about that. Having said that, with this chart, I'm going to show you a few of the things that we've seen as far as performance goes in various accounts. This may or may not be connected to you, and I'm going to show you why in a minute. Just depends on how you're invested, your risk tolerance, and so on. So when you look at this, this is 4 asset allocation models we have. The red line is 80-20, meaning that 80% stocks, 20% bonds. This is a 60-40 model, the yellow line, 60% stocks, 40% bonds. The green line is a 40% bond, 40% stocks, 60% bonds. And then this is a 70-30 mix, 70% bonds, 30% stocks. And so you can see on those the performance, and this was as of just last Friday. And so it's nice. Actually, the fact that the markets have come down a little bit yesterday, they're a little bit off of this, a little bit lower than what this is showing if I pull that chart up. But what I would say is that from an asset allocation mix, depending upon where you are and how you're invested, whether you're more growth oriented or more conservative, whether you're more income oriented, all these pieces can have some impact in where your numbers are compared to these charts. But it's just to give you an understanding that from January 1st, including the market downturn, and then to where we are today, the things are moving forward in a nice performance pattern. If in our next meeting, or if after today's meeting, you say to yourself, I want to make sure that I'm more aggressive in my thinking and our investment strategy, please let us know. Happy to make those adjustments. We try, again, to be client driven and advisor managed. And so if you say, I'm really conservative, then we're going to work on that model for you. If you say I'm more aggressive, then we're going to work on that model as well. So this kind of gives you some of the asset allocation models we're working with. This next chart is showing some particular asset groups, items like gold, IBIT, which is an ETF that trades in Bitcoin. We're looking at the bonds. We're looking at high yield. We're looking at worldwide stocks. And so you can tell gold has still been the best performer so far this year. We can see that IBIT or Bitcoin has also done well so far this year. We can see that international has done well this year. Matter of fact, everything is in positive territory. It's just that some things are obviously more, and you can see the performance numbers over here on this. Also, you can tell things like gold has flattened out a bit. IBIT or Bitcoin itself has flattened out a bit, but items like worldwide stocks, items like the NASDAQ, which is tech oriented, and the S&P 500 are moving up during this short period of time. So again, as we're looking at your portfolio, we can make adjustments. These aren't the only things that we invest in, obviously, but this does give you a better look at 5 very diverse asset groups and how they're impacted based on the market downturn we experienced back in March and April, and this most recent climb up since May and June. So that hopefully gives you some ideas as well. Same thing as I said momentarily, or a moment ago, I'm sorry. If you want to become more aggressive, then let us help you do that. If you want to become more conservative, let us help you do that, because we can show you the various opportunities to do both. And as we're looking at growth versus income and your risk tolerance, we can put together models for that as well. Matter of fact, we have the models already in place. It's just a matter of making sure that you have the right investment strategies for your long-term midterm, and short-term goals. As I've shown you many, many times before, these are the 8 different primary investment categories we work in. We work with cash reserve programs, bond programs, stock programs, real estate programs, tangible assets, things like metals and commodities and energy, currency, the US dollar versus other currencies around the world, private business interests, and then insurance and annuities for those who want to have some market opportunity but want guarantees or safety nets built into it. We're able to build the portfolio with these. We have many great programs to work with. Depending on which ones you are needing for your mid and long and short-term goals, impacts how we set these up for you. But wherever it is, we're trying to use intelligent portfolio management strategies that are proactive wherever possible and reactive whenever necessary. So that's the purpose of these, is to help you achieve your goals for you and your family on your current needs as well as your future needs. We continue to utilize our portfolio management process, and we'll continue to do that for you for equity investments, for ETFs, for bond programs, and so on. This is how we're able to stay on top of all these items to help you and your family grow wealth. And again, think of all of these little charts that you see, these little thumbnail charts. They really are nothing more than just ingredients in your investment portfolio recipe. You say, I want a more aggressive portfolio, we can make that. You say, I want a more conservative portfolio, we can pull from the various charts here to put that together. And so that's part of what we do to help manage money wisely. And then when the markets and the world change, we make adjustments to protect. But once everything's back to normal, we get right back to where we were before. So again, I've talked with, I'm pretty sure everybody on this call, but many times before we've had these conversations. And the only thing that would ever adjust what we do is by you saying, I want to, and you just fill in the blank, whatever you're trying to do with your portfolio. If we can help you accomplish that, you have my word, we're going to do that. So that brings me to a point that I've mentioned in the last few months several times, but I thought I'd spend a few moments on that today. And it is your risk tolerance and the portfolio management we do with you. So here's what I would say about that, is that we have software on your financial plan, on your financial dashboard. It's over here to the side in this area, usually when you look at it. It shows these 2 risk numbers. The risk number is what your risk number is, and the bottom box shows how your investments are currently set up, matching that risk number calculation to your risk number. So let's talk about what this means up here. When you take the nitrogen test, it helps you score your risk tolerance on a scale of 1 to 99. 1 is a full-on risk avoider, 99 is a full-on risk taker. And so depending where you are, we will help you match your investment strategies in that portfolio or in your portfolio to match what your tolerance is. Now, why is that important? Because when the market falls, if you're invested too aggressively, you will panic and feel like everything's been done poorly. You've made a huge mistake. And we don't want that for you. We want you to have confidence. And so what we try to do is, to the best of your ability and our ability, to assess what your risk tolerance is, and then help you use that basis as how to do all future investments. In this example, this person has a risk score of 73. That means that obviously they're in the upper 50 percentile of risk takers, but they're not above 75, so they're not in the highest quadrant. They're in the next to highest quadrant, and they're at the top of that. So that means they are comfortable with risk. To put them in a portfolio that would measure, say, an 80 or a 90 could be terrible if the markets fall apart and they see the downturn in the portfolio that terrifies them. And when I say that, what I mean is this, is that you think in terms of, well, what if the market fell 10%? What does that mean? Most people don't really stop to think about what that means. But if you say to them, what if your portfolio lost 25,000 or 100,000 or $200,000, would you panic? That's what this is about. This particular program, Nitrogen, helps you and us understand what it is you're trying to do as far as risk goes and how much risk you can take comfortably. The market's going to fall, just as we saw here back in April and the subsequent May when it came back up again. It fell, and it fell a lot. So if a person had $100,000 portfolio, the reason I showed you it fell 19%, that meant that they lost $19,000. For some people, they'd be like, yeah, I'm comfortable. The market's going to come back. I'm not particularly worried about it. For other people, that'd be too much. They'd say, get me out. I can't take that. And so we use this scoring system with nitrogen to help you figure out what you can handle and help us match that up for you. Now, if I come down to the portfolio, your portfolio risk number should be associated somewhere with your personal risk number. And this portfolio risk score includes the investments you have with us, and it can also include the investments you have outside of us. So for instance, you have a 401k. We can actually include that in your risk profile to say that with the investments you have with us, plus your 401k, or maybe you have 2 or 3 401ks from different companies, we can put all of those into your calculation and say your portfolio scores 69 as compared to your 73 risk tolerance. Now, is 69 too low? Depends on the person. Some people, their risk, this number could be 79, and they'd be like, I'm okay with that. 79 is not too much. I can live with that. Other people be like, don't ever go above 73 because I don't think I could handle that. And so we use the nitrogen software as part of your planning process to help make sure that you have a risk model that matches what you can live with if the markets go negative on us. Now, that's why we spend a lot of energy and time on this discussion with people. And it's just one of the softwares that we provide to clients to help understand what you need and to help you be able to assess your risk as we're making decisions for you. Now, that brings me to the second part of this. Expectation. I used to think a long time ago that I managed money. What I really have begun to realize over the years is that I actually am managing expectation. Yes, it's true. We're managing money. We're making investment decisions. Yes, that's all true. But what I've really realized is that with clients, when their expectation is set properly, then everything seems to work well. Now, what I learned over that same time period is that sometimes people don't know what they mean by expectation. And I actually learned this from a mentor. It's got to be probably 2 decades ago, where he said if you take the word expectation and you take the I and move it to the front of the word, it turns into I expect a ton. And he wasn't talking about money managed, but it was something else he was talking about. But it was a really good realization that expectation, when set properly, works very well. But when it's not set properly, it is very much like expecting a ton from what's coming out of that. So let me tell you how I want you to understand that going forward here. This creates, all this information here creates a realization that is this: it is impossible to have a low risk portfolio and achieve S&P 500 returns. Now, I have to tell you, I've had plenty of times where people would say to me, well, my friend has gotten this return on their money. And I said, well, how were they invested? Well, they didn't know because they really didn't talk about it. They just knew what the return was. And I said, well, if their portfolio is invested more like the S&P 500, they're going to do better. If you're invested in CDs, which are much more conservative, you're not going to experience that S&P 500 return. But with this scoring from nitrogen, we can then help identify what is a more realistic expectation for you. So for instance, if the S&P 500 had a positive 10% return and your risk number was a 50, that would mean that you would expect about a 5% return on your money, on your investment. Doesn't mean it's guaranteed. It just means that that would be a reasonable expectation. So if you said, well, Frank, I want more than 5%, then we'd have to look at what your risk number says and how much risk you're willing to take to get you closer to what that long-term goal would look like. Conversely, if the S&P 500 had a negative 10% return and your risk number was 50, that would mean you would expect realistically a negative 5% loss. So some people be like, well, I could live with that. I just want to make more money. And so the balance of portfolio management is to try to figure out how do we get the most return possible and take no more risk than the client is comfortable with. And so, as I said before, I think that it's fair to say I and our team, we manage money, but in reality, what we're really trying to do more than anything is manage a client's expectation to make sure we can meet what they need and what they want. And so that nitrogen software, if you have not used it yet, my encouragement is that we do use it. If you have not updated your numbers in a year or two, it's probably time for us to go ahead and do that with you. The reason I mention this is right now during the summer, when we sit down with people, this is one of those times when we try to talk about this to bring up the nitrogen scoring, your risk tolerance, and to make sure your financial planning and your portfolio management are blended well to meet your short, mid, and long-term goals. Anyway, I wanted to share this part about I expect a ton because I thought that was a fantastic statement. And it has changed my perception on a lot of things with my expectations. Me personally, I try to figure out, is my expectation realistic or is it that I'm expecting a ton? So hopefully you can use that with your children or friends or somebody. So this brings me to what we've closed out the last few months on, and I think I've beat this horse enough for right now. But what we're doing, as always, is trying to tie together three analytics that are essential for managing wealth wisely in today's world. That is fundamental analytics, which looks at, would I invest in something now? If I'm going to invest in an industry or a stock or an ETF, would this be the time to use that? Would I be in financials or would I rather be in technology? Which fundamental analytics say is the best of the 11 industries to be in, for instance? Secondly, we use technical analytics because even if we say, well, you know what, Ford Motor Company or Taiwan Semiconductor or Meta, those sound financial companies we should invest in. Maybe, though, technically today's not the day to invest. In essence, fundamentally says, would I invest? Technically says, would I invest today? And I'd say the converse of that is if the market's going south, technical would say, should I stay invested if I'm in there? Should I hold it or should I sell it? Or should I buy more? And that's the difference between fundamental analytics, which tells you everything makes sense or it doesn't make sense. Technical analytics tell you whether it makes sense today. And then behavioral analytics is really, it's a growing science. It's not that it hasn't been talked about before, but I've noticed more and more over the last couple of decades about behavioral analytics, meaning that people are realizing that it's not just, should I invest in this? Is now the time? But it's also, what is everybody else doing? Not like we're following the herd, but rather, is this the time to utilize this strategy? I can go through dozens of investments right now where I would say behaviorally, they are seen as a great opportunity, which means that people are throwing money into it, which means that that could be a great opportunity as well. And so there are various pieces here that fit together fundamentally, technically, and behaviorally to help put together a portfolio that matches what a client's needs are, what your needs are. And I would say, again, it really does tie back to your expectation, what it is you're looking for. Are you looking for a 5 to 10% return? Are you looking for an 8 to 12% return? Are you looking for a 10 to 15% return? And if you can get that, can you handle the risk associated with it? Or is it going to cause you to lose sleep at night and not want to invest ever again? That's why we tie all three of these together. So as I've said, even in this conversation a couple of times, we are client-driven, advisor-managed, and that is us trying to help you accomplish your family wealth goals today, tomorrow, and for future generations. And so that's a big piece of what drives us in our conversations for you. I've shared this with you many times before, but this is, in my opinion, the sort of pièce de la résistance, which means that this is that piece where I think to myself, we can invest money, we can put it in equities or annuities or stocks or mutual funds, whatever. We can put it in multiple different things, but in the end, you're not interested in having a big pile of money. What you're interested in is getting what that big pile of money can get you. It's your return on life down there at the bottom where it says, what's your desired return on life? And so as I've shared this with you before, I'm going to just remind you that you go through accumulation phase, pre-retirement, you plant your flag, you say, I'm ready to retire or redirect. Then you go through the decumulation phase where you start pulling from your investments, you start living your life in the latter part of your years. And then at some point, we all pass away, and then you transfer whatever you have left to the people that you care about. And so having a good plan that goes all the way through that process is what we try to help people to create and to grow and to protect and preserve in that process of that financial journey. And some of you are on this side of the mountain, and some of you are on this side of the mountain, and I'm pleased to say none of you are over here yet, but we know that all of us are going to get there sooner or later. And so we try very hard to help you determine your destination and then take the directions that are going to get you from here to there. And planning and investment management is a big part of that. I shared this with you last couple of months, because in the end, no matter how great the investments go, the bottom line is, do they help you achieve your wealth goals and your income goals? Do you have positive wealth gaps and positive income gaps, or negative wealth gaps and negative income gaps? And if so, how do we help you offset those or make the most of them, whichever is needed? That's why we provide you the IXL financial dashboard, which is really multiple pieces, obviously e-money, nitrogen, which I mentioned a moment ago, as well as some other resources to help you have a way to stay on top of where you are. And this is probably the best tool I've ever worked with in my very long career on helping people to identify income and outgo and what they own and what they owe, the 4 components that help determine what's going on with your family wealth today and what's going to happen in the future with it. And to that point, I'm going to remind you that the way we handle our appointments is for our financial planning clients. The first trimester is focused on spring planning, review, and renew, trying to help figure out what you just did the last year. Did it meet your goals? And then what do we want to do this year to make that happen? Currently, we're right now in the second trimester, which is looking at investment and insurance review. And so we're reaching out to clients and saying, hey, let's sit down, take a look at your portfolio, take a look at insurance questions you might have, trying to make the most of that. As you can see here, in August, we're going to be moving into the third trimester, which is focused on tax planning and estate design. Tax planning to make sure you've got all the tax tools in place to make sure you don't give to the IRS any more than you need to, and that you've got everything put in place to keep as much of it on your side of the balance sheet as possible. And then estate design is to make sure that how your assets are set up, they're going to work with the estate plan you have in place, and that your beneficiaries are set up properly with our accounts and with accounts outside of us to match what your estate design looks like. And so that's what we're going to begin doing. We call that the third trimester, or T3 meetings, and we'll be calling you for that. Having said that, even though we're calling you for these 3 meetings, we're always available to sit down with you and talk with you anytime. So if you have any questions or needs or concerns or thoughts, feel free to give us a call. You don't have to wait till we call you. We're happy to sit down and have that conversation. And then once we get to the end of this, we'll start over again and start with our pre-planning and year planning, year-end planning, spring planning activities for all of you as well. The next thing I'm very excited about is that, and I really thought we'd get this done way sooner. It's taken forever. And I would give a lot of credit to Stephanie. She has done excellent work at finally getting this set up. It wasn't her job. We've been trying to hire editors and videographers and people to help us get all this set up to make it so that we could get all of our wealth advisory reviews, this meeting here, for instance, on our website. And if you were to go to our website tonight, you would see right there is the June wealth advisory. Within a week or two, you'll see the July wealth advisory. And you're also going to see that our YouTube channel is going to start having more of these. We're also breaking them out into small vignettes so that they are, instead of this hour-long program, they're 2 minutes to 5 minutes with little brief areas of what we think are very important for you to understand. And we've got a whole big plan going forward this year and into the future to really start sharing this information on a timely basis to a broad group of people, not just through our website here, but through a YouTube channel, through LinkedIn, and several other platforms that we have coming down the line. So looking forward to that as a way to help you be able to pass on information to family and friends you love and care about, that you want to see some of this information as well. So very excited about this. I believe we have everything caught up for the beginning of the year, although we might not have January updated yet, but everything from then I believe we have done. And just looking for more and more of that. As the YouTube channel and everything begins to really fill up, I'll start showing you that in future videos as well. So those are our 2 big announcements. We're changing from Pershing and Allbridge to Fidelity and Black Diamond. And the videos we wanted to do to make it so you can see them. If you miss them, you'll be able to go to the website within a week or so and fix that. And I will tell you, that's not my goal a week from now. Our goal is to make it so that we can have it so it'll be done within 2 days after the video. But we're not there yet, but we're getting there. So that'll be the plan. So that if you miss tonight's program, you can certainly see it by the end of the week. It'd be our long-term goal, but for right now, it'll be a week or so out. So now brings to that point where if you have questions, I can answer. I'm more than happy to do that. I'll check here in a second, see if there's anything in the chat boxes. But before I do that, let me just tell you this. is that the market fundamentals, technical analytics, all the pieces that I've shared with you tonight, plus a lot more, will be the next advisory review will be on August 12th. And unless something dramatic or exciting happens that we need to do before then, I will get together earlier, but assuming nothing changes from normal, August 12th is when we'll be doing this. If, again, you have family or friends you want to invite to this, please let us know. I'll be happy to send them an invitation as well. The one thing I will say is that depending upon, we're going through training with Fidelity right now. Augusta, Melissa, Stephanie, and myself, others are going through the training. As soon as we are ready to go with that, we'll be putting together a quick webinar to sort of update you on what you can expect from it. We're going to be handling each step, so we'll be inviting you to that, but I don't know when that's going to be yet because we're waiting to get everything finalized with Fidelity first, which probably will be by the, well, so what's today? The second week of the month. Probably within another 2 weeks, we'll get all that started, and then we'll probably put together a webinar for that specifically for all of you who want to get updated quickly on that. So, as I said a moment ago, my goal tonight was to talk about the data supporting the V-shaped recovery and what I think that means, and how there could be some potential volatility, but right now the charts look very, very nice. Taking a look at President Trump, the economy, and how that's impacting your wealth management, your portfolio management from our side as well. How our strategies and our investment portfolio modeling is working and what we think we see coming down the road. Reminding you one more time, I know it's a few months in advance, but don't forget about year-end tax planning because, as I said earlier, 99% of all tax reduction strategies end on December 31st. And after that, you're just left with whatever you can in an IRA deduction if you want to. Talk about the difference we're bringing to the table. Hopefully that becomes more and more apparent as I share with you our big announcements, which I'm very excited about. And then now I'm going to go back and see about your questions. Let's just see if you have any questions. Most of the time you all are like on top of everything, so I don't need to tell you anything. Oh, what's this here? See a little badge. Oh, Q&A. Looks like there's 2. So we got here. Okay. Okay. So this seems to be way over my head and very confusing. Is there a way you can explain this in simple English for new investors? Carl and Penny, let me just say this, that I think for all investors, when they start with these discussions, it seems very complex. It's a lot of stuff. This is probably the reason why people hire us to do the job, because we bring other pieces to the table. Are there ways to explain this more simply? There are some things we can do. Matter of fact, I would say that in our next appointment, let's break it down to some things. But what my encouragement be is write down some questions of things that you're like, I didn't get what that was about at all. And let's talk about that, see if we can help with that as well, because there's no dumb question. This is your money. You've worked hard for it. You deserve to understand everything you can. The technical analytics of what we do with the markets and so on, quite honestly, we live in a specialized world where flying airplanes, driving big rigs on the highway, being a doctor, they're all highly specialized. And so sometimes everybody has to do their part their best, but certainly when it comes to more simplified answers, I think that's probably more on a one-on-one conversation. I'd be happy to do that for you. I know Brent would be happy to do that for you, and we'll see what we can do to help with that. And then, do you have a certain amount of money to be part of Black Diamond? Nope. When you open up your accounts for Black Diamond or with Fidelity, those will then move right in there as well. And we're not, so while we're having SFA's strategic blueprint as part of what we're doing, we're still with SFA. And there's other investments that don't require Black Diamond or that. And Black Diamond is really nothing more than a financial dashboard. That's all it is. It'll be your accounts in Fidelity investments, the mutual funds or the exchange traded funds or individual stocks or bonds. Those will be what will be held in that platform. And then Black Diamond will report that information to you and all of our clients. Hopefully that helps a bit. And we'll talk more about the other as we meet with you. And in our next, the update for this transition to Fidelity, I'll cover that more in detail there. So let's see here. Oh, sorry about that. There we go. All right. So that brings us to the end for tonight. And as always, I would say to you, I am honored. Our team is honored to serve you as clients and to have you as clients of the firm. Anything we can do to help you achieve your goals, that's what we're here for. And so please feel free whatever questions you have after the meeting or in the next time we meet, feel free to ask those. We're here for you. Write them down, bring them with you. That's how we handle a lot of these items. If you have more questions after the meeting tonight, write them down and email us. We'll be happy to get back with you and answer those as well. As I said before, August 12th will be our next advisory review unless something weird happens, and then we'll send you a special invite for a different meeting. And if something really weird happens, like a pandemic or like a great market crash, hopefully neither of those things will be an issue, but we're here for you every step of the way. So for now, that's all I have. I am looking forward to getting out of here, go have dinner with Jane, and have a night of peace and rest and enjoyment. And I hope the same thing for you as well. So have a fantastic day or a fantastic evening and a great week. And I will look forward to talking to you soon. So do well, and we'll be talking soon. And until then, God bless.